So, back in 2025, something pretty wild happened in one of the world's major stock markets. It didn't just grow, it absolutely exploded. Today, we're going to break down how the South Korean market pulled this off, and, maybe more importantly, what it teaches us about what happens after a rally like that.
Just look at that number, 83% in one single year. Let that sink in for a second. That's more than triple the average annual return of the S&P 500? This is the kind of thing that makes everyone in the financial world stop and take notice.
So, the big question is, how on earth does that even happen? And for anyone investing, the even bigger question is, what's your next move? What do you do the day after the party? That's exactly what we're going to unpack here.
Yeah, in 2025, South Korea's Kospi Index wasn't just a strong performer. It was the #1 best-performing large stock market in the entire world. This wasn't some slow and steady climb. It was a rocket launch.
So, what was the fuel for that rocket? Well, it was a perfect storm, really. You had two massive forces coming together. About half of it? Yeah, that was the global hype around AI. Everybody wanted a piece of the semiconductor action. But the other half, and this is the really interesting part, came from a complete revolution in how Korean companies are actually run.
To really get why that governance part was such a game changer, we have to rewind a bit. We need to look at this problem that had been holding the market back for years. Let's dig into this thing called the Korea discount.
For decades, you had these incredible, world-class companies in South Korea, but their stocks were always, and I mean always, cheap. It was this weird, well-known phenomenon. It was like having a Ferrari that for some reason you could only sell for the price of a Toyota. The share prices just didn't match the quality of the businesses.
And why was that? Well, it was a whole cocktail of issues, but they all pointed to the same thing. The system was often set up to benefit the founding families, not the regular shareholders. You had weak rules, companies that barely paid dividends, and these super complex ownership structures designed to keep control locked down. It all pushed valuations down.
And right at the center of all this, you have the chaebols. Think of these as massive, family-run empires that basically form the backbone of the Korean economy. If you don't understand how they work, you can't understand the Korea discount.
Okay, so how do you fix a problem that's so deeply baked into the system? It's not going to fix itself, right? Someone has to force the issue. And in this story, a group of investors did way more than just buy cheap stocks and cross their fingers. They became activists. They basically wrote a new playbook for shaking things up.
And you can hear it right from the source. The fund's manager, Jonathan Pines, said it perfectly. They believed they were able to influence the outcome far beyond our expectations. This wasn't just investing. It was a full-on campaign. They published research, they met with regulators, they made their case loud and clear.
And they didn't just show up with vague complaints. No, they came with a plan, a very specific 6-point plan. Things like ending forced share swaps and requiring shareholder approval. That was all about protecting the little guy. But the big one, number 5, was about changing the law to force company directors to act in the best interest of all shareholders. It was a direct shot at the heart of the problem.
And guess what? It actually worked. Their ideas caught on, got public support, and the government listened. They started pushing through huge reforms, including a brand new law that said, yes, company directors have a legal duty to every single shareholder. That was a massive deal.
All right, so seeing that a whole country is about to change is one thing, but knowing how to actually invest in that change, that takes a whole other level of discipline. So let's peek inside the absolute return mindset that made it all possible.
This gets at a classic investing debate, right? Is it better to just be in a hot market, or does it matter more to find the absolute best companies, no matter where they are? For this particular team, the answer couldn't be clearer.
And this chart just says it all. Look at this. Over 16 years, trying to pick the right country gave them basically zero outperformance, what investors call alpha. All of their success, a solid 5.4% of alpha, came from picking the right stocks. In fact, their stock picking often had to bail them out of being in the wrong countries.
And this, right here, is their secret sauce, the absolute return mindset. For them to buy a stock, it has to pass one simple but incredibly tough test. Can it, all by itself, deliver a 15% return every year for 5 years? It's not about being the best-looking house on a bad street. It has to be a great house, period. So what does that look like in the real world? Well, they look at a popular stock in a hot market like India and say, nope, too expensive. We just don't see how we get to 15% a year from here. Instead, they'll hunt for value in places others might be ignoring, like with JD.com in China or Bangkok Bank in Thailand, where the low price gives them a much clearer path to hitting that target.
At the end of the day, it's about being a disciplined value hunter. It's not about chasing trends or following the herd. It's about finding great businesses that, for whatever reason, the market has put on the discount rack.
Which brings us full circle, back to South Korea. You've had this incredible 83% run-up, a rally you helped create. What do you do now? This is where the discipline really gets tested. It's easy to be disciplined when things are tough, but what about when you're winning big?
They didn't just pop the champagne and let it all ride. Nope, they got to work. They trimmed their position way back, sold the stocks that had gone up the most, and took that cash to go find new bargains in other countries. All while, of course, holding onto the stocks they felt were still cheap.
And this just shows you the whole strategy in two pictures. On the left, you see them going all in as their conviction grew before the rally. And on the right, you see them after, a much more balanced position. It's the difference between planting the seeds and harvesting the crop.
And this is the main takeaway from their perspective now. The rally was justified. It wasn't just hot air. But, and this is the incredible part, even after an 83% jump, they argue South Korea is still cheap compared to the rest of the world.
Samsung is the poster child for this argument. Just look at this table. It shows the price-to-book multiple, which is basically what you pay for a company's assets. When you compare Samsung to its biggest competitors around the world, it's not even close. It's dramatically cheaper, which in their view makes it one of the best big company AI plays anywhere on the planet. You know, this whole story is such a powerful lesson. It shows that sometimes it's not enough to just find a cheap market. Sometimes you have to have the conviction to get in there and help unlock the value yourself. The 83% rally was huge, no doubt. But the question that's left hanging is the Korea discount really gone for good? Or was that just round one?